Hi folks, so today we are going to cover the editorials for the Economic Times of 4th of January. So these are the editorials which came in today's newspaper, and I feel that this is much relevant in context of what is happening in the Indian economy with the perspective of all the regulatory bodies. So let's go, and this is just going to be one editorial for the day. So the editorial says, let's algorithm with the flow, or let's algo with the flow. So SEBI's move to open high-frequency trading for retail investors will enhance democratization. Okay, so high-frequency trading and that open high-frequency trading will allow the retail investors for their democratic decisions. Okay, so SEBI recently announced plans to allow retail investors to use algorithm trading soon. It had allowed institutional investors to do so in 2012. That resulted in trades happening in fractions of a second at lower cost with greater transparency. A recent SEBI study showed that 97% of the profits of foreign funds in financial year 24 were from algo trading. So it basically says that when algorithm trading was introduced, it was very beneficial in terms of the profits and also to have a greater transparency on what is going on. So in financial year 24, 97% of the profits which was made through foreign funds, it was this number and it was quite high. So the directive is intended to bring trading parity between institutional and non-institutional investors, but a level playing field is unlikely considering the firepower that institutions have by way of tools, tech, and aggregate experience. NYSE computerized order flow in financial markets in the 1970s, and simple algorithms helped execute trades at the best rates. While the computerized analysis of markets became progressively better, it was the 2000s that marked the rise of high frequency trading. So it basically says here that level playing field is likely to be given for both the institutional and non-institutional investors. And considering the capability of these tools, it was observed that in the financial market in the 1970s, the simple algorithms helped execute the best trades. Okay. Now, while it is becoming better, while the technology and the computerized analysis are getting better, it was in the 2000 that marked the frequency of high frequency trading. Okay. With the advent of AI and ML, algorithms were created to predict market trends. Engines that analyze news and social media helped assess sentiment too. Other innovative avenues of advantage emerged from lower latency networks, alternative data sources like geolocational inputs that provided a more comprehensive view of market dynamics, user-friendlier platforms, and cloud computing for enhanced flexibility vis-a-vis the computing resources. So essential for scaling. So high frequency trading has changed the rules of the game substantially. So it says that with the advent of AI and ML, we are able to predict the market trend in a much better way, and it also helps to assess the sentiments, right? The other innovative avenues which the world is progressing to is like to emerge from the lower latency networks, okay, and use alternative data sources like geolocational inputs, which gives a much comprehensive view of all the resources for scaling. So this high frequency trading has changed the rules substantially from longer term patient buy and hold investing to rapid arbitraging, marking small profits on price differences across markets. Holding of securities for milliseconds has now become unexceptional. So development of such complex algorithms and their deployment involves substantially investments in tech infra and skills. So these are the updates. So algorithm trading may operate at a slower pace. Slower pace involves fewer trades over longer time frames and encompass diverse strategies, including following trends, executing trends based on deviations from the average price, and arbitraging. So it says that algorithm trading it can operate in a slower pace and it may involve longer time frames to diversify the strategies and executing the trade. Okay, so this is one of the setback that it cannot happen that instantaneously, but it will happen through a slower pace. Flash crash is a notorious incident that happened on May 6, 2010, when major US equity indices crashed by 9% within minutes before recovering. So this resulted in loss of $1 trillion owing to algorithmic trades triggering a selling wave. 5 years after the US Department of Justice ascribed the outage to London-based Navinder Singh Sarao, he had placed orders for $200 million futures contract that were replaced or modified 19,000 times before they were cancelled. Okay, so these are a few of the updates which are given totally in numbers. And what do we mean by futures is like the basic uh, thing which we know is futures and options. Futures and options, they both are traded in the uh, market. Okay, I mean, there is a regulatory body to regulate them or to observe, like to supervise them also, like what is happening. So these are basically done in the stock exchanges. Another infamous disaster, not entirely algorithmic, was when a JP Morgan Chase trader lost $6 billion and the firm incurred about $1 billion in fines in the Londonville incident of 2012. This highlighted how automated systems managing complex derivative strategy without adequate supervision can have catastrophic outcomes. So few points are given here. So these three are few of the uh, points in which like it was highlighted like how algorithm trading is affecting the whole of economy, how crashes were happened, and the disaster in the economy which happened and it resulted to catastrophic outcomes. The third example again is Knight Capital Group, a major US trading firm, experienced a massive failure in 2012 when a dormant trading algorithm started executing millions of erroneous trades repetitively. This resulted in about 600 I mean $460 million in losses less than an hour. So the firm couldn't recover from this setback and was acquired by a competitor, underscoring the point that automatic trading turns an otherwise manageable error into an extreme outage with ruinous consequences. So here it says that the three different crashes which took place, they had major consequences in the whole of economy. Okay. And it up to such extent that the whole of the company was shut down. So risk emanates from the reality that an errant algorithm executing high frequency trades can cause huge losses in exceptionally short periods. So as financial markets are intrinsically linked, the resulting shocks can be rapidly transformed. So basically, if one of the organization or one of the sector is impacting, the other shocks, I mean, the shocks will be that prevalent that it can affect the other sectors in the economy as well. So it could also affect other asset classes like real estate. Now, HFT, high frequency trading, is also amenable to spoofing, which involves placing massive volumes of fake orders to create the illusion of demand before canceling them. A computer malfunction could create a big trouble, as happened in the Intercontinental Exchange Group in 2014, when about 20,000 erroneous trades had to be annulled. In 2014, the Nasdaq OMX Group introduced a mechanism to cut off trades between a pre-specified exposure level and insisted that derivatives trading firms must have pre-trade risk controls. Other measures for mitigation could include volatility filters that could trigger changes in trading strategies, monitoring of illiquid conditions that could cause losses, diversification in investments and across asset classes and markets, and strict regulatory compliance. So here it says that HFT, it can be amenable to spoofing. Why? Because, for example, if one of the investor plays a large demand, okay, large fake orders before the demand is actually bought, so that can also be one of the areas where people are getting, or if they want to take that share, that will be at a very high price. Also, the computer malfunction, which can also lead to some technological disruption. So these are the things which this editorial highlights. Also, NASDAQ OMX has introduced a mechanism to cut off, but uh, to determine how much the exposure level is pre-specified. And a few big Wall Street players have registered with SEBI as setting up HFT entities for proprietary trading to start with, while some will offer broking services to smaller proprietary traders. These include Citadel Securities, Tower Research, and everything. Growing in volumes and liquidity is getting global attention now, and firms are developing big database strategies specifically for India. So SEBI seeks to regulate HFT in India by mandating 6 monthly audits, strict order to trade ratios to control the volume of orders to executed trades, check for timely execution, randomization of order queues, and disincentivize for high daily OTRs. So it says, the SEBI says that HFT in India will be regulated by SEBI for 6 monthly, and in all those 6 monthly, I mean, it will be audited by SEBI and it will be regulated by SEBI, but a 6 month audit will be mandated by SEBI. Okay, and strict order to trade ratios will be there to control the volume of order to execute trades. NSE began offering co-location facilities to brokers in 2010, whereby they could place their servers at NSE's data center for faster access to market data. When high frequency trade came into focus and milliseconds started to make a difference, the issue of some trading members getting preferential access to less crowded secondary servers enabling faster trades became a very contentious issue. So SEBI's investigations revealed a procedural lapses but no collusion. Okay, so SEBI's need to allow non-institutional investors to engage in HFT is a step that will enhance democratization of trading. As the NSE incident showed, there will be many known aspects to protect, including volatility, manipulation, and overtrading. There will also be many aspects that both are unknown and indictable. Okay, so there will be many issues which we will be not knowing as of now and which we cannot prevent also in future. So basically, the crux of this whole editorial is that whatever the SEBI is trying to do, it is going to allow the retail investors to use the algorithm trading. Okay, and there were few instances wherein how can it be achieved and how beneficial it is. For example, the uh, speed at which this whole mechanism takes place, the greater transparency, and how the foreign investors are getting benefited from that. Then how before also, when all these things were introduced, there was a computerized order flow which started back in 1970s. And with the rise in the market, so in during the 2000, high frequency trading was introduced. With AI and ML, the market trends are getting more predictable and it is also scaling high. People are using it to invest for longer term and then buy and hold investing to rapid arbitraging. So it's like very dynamically everything is happening. Okay, so if some people want, they can hold the money. If some people want, they can transact the money very rapidly. It also says that algorithm trading is operating at a slower pace, but with time it will gain its speed, and it will also encompass diverse strategies in following trends and executing trade based on deviation. Then there were few crashes, or which we can say notorious incidents, which happened with all this advent of technology. Flash crash, then JP Morgan Chase Trader lost. Okay, and this Knight Capital Group, it lost because of the firm couldn't recover the setback. Okay, and the algorithm started giving erroneous trades repetitively. So risk was emanating from this HFTs and it was causing high loss in short periods. Okay, and it is also amenable to spoofing. For example, any investor can place a large bulk in order, and then he or she can resell that in high prices. Then Nasdaq has introduced a cutoff mechanism. A few big Wall Street players have also registered with SEBI and they are offering to trade in HFTs in India. SEBI will be regulating HFTs and it will be having 6 monthly audits. I mean, 6 monthly audits. Okay. And that's all. Then after that, we just see that how it is getting concluded here. So NSE began offering co-location facilities in 2010 to the brokers, and then SEBI's decision to allow non-institutional investors to that will encourage the democratization of trading. Okay, and here, as the NSE incident showed, that all includes volatility, manipulation, and trading. So there will be also many aspects which we cannot prevent and which are still unknown to us. So that's all for this. Have a great day. Bye.